Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Now, the goods and service tax regime is underway, with rates having been fixed for most goods and services by the GST Council at around 18%. Just to recap, some 81% of goods will attract tax equal or lower than 18%. More importantly, the government has said that the overall tax burden on the average household will decline after the implementation of GST. Now, as this regime gets going, the question we are asking is, how will the combined impact of GST impact consumers and industry in terms of costs and compliance? What has been missed out? What are the key challenges ahead? To discuss this, I am joined by Deepak Premnayan, President of the IMC Chambers of Commerce and Industry, and also Rohit Jain, partner at tax firm ELP. Thank you both for joining me. Mr. Premnayan, let me begin with you. So we have got most of the rates with us now. There have been some concerns about some specific commodities or specific products that seem to be either attracting too much or too less. What's your sense at this point?
You look at what's happened now, is that the intention which is coming out of ease of doing business, it's no longer got to do with tax reforms that are in place. Take my chamber, for instance. My biggest issue has been is that in terms of competition globally, today our taxation rate is about 27.5%. This will take us down to, let's say, 19% or 18%. I will then have this benefit of 9.5%, which is octroi, sales tax, VAT, etc. So I'm going to be more competitive. The biggest other advantage is that there is a liquidity issue that we have in terms of the cost of money for my SME, MSMEs. Interest costs are very high. With GST falling in place, there'll be a whole lot more indirect tax collection. And I expect liquidity to improve, therefore more monies to be available, therefore interest costs to drop. So it's going to be 11.5 to 12% benefit between the tax rate and the liquidity.
Right. Okay. Rohit, if you were to look at the process, so the intent is something that has got translated favorably so far. The process of this translation, are you seeing it lead to what we hoped it will lead to?
Yes, mostly yes, but there are still some points which are misses yet. There was a discussion on the draft e-way bills, which was like not only interstate supply, even intra-city supplies. If the goods have been transported more than 50,000, there was need to have an e-way bill. Now, e-way bill in that sort of a delivery and that sort of a supply will not have a ease of doing business. And therefore, while good news is that there was absolutely no discussion on the e-way bills, and hopefully those rules have been, as of now, on hold, may not be implemented simultaneously, GST being implemented. But yes, on overall basis, there have been a lot of positive things which will achieve and what has been intended to achieve on implementation of GST.
Let me just revisit the impact, right? So we've also seen goods, and we've seen services. In services, we are looking at 5, 12, 18, 28. Very few categories at 28, but that includes movie tickets. So what is from your understanding as of now in terms of cost of living?
As far as services are concerned,
combined, I'm saying combined.
Combined, it would be really at par of today. It may be slightly higher on some of the aspects.
Like
but
going to a restaurant,
staying in hotels. Say, for example, simple thing, food products or some basic pulses and grains and all, which is today liable to no rate of tax. Most of them are nil rate of tax, but the branded products have fallen into 5%. Today, why do I branded products I buy? Not only because they are branded, but it's a hygiene, it is more pure form of quality of product that I get. But then ultimately I needed to end up paying 5% tax on that, which is not definite. Netly which was been looked after. And therefore some cases there would be a higher cost of living. But overall, it will be at par what we have today in terms of existing burden of taxes.
Right. So therefore, there's nothing to be concerned as we move into the regime, except on the implementation, and I'll come back to that. So, when you look around your membership, what is the extent of preparedness from understanding, knowledge, technology, systems, processes?
Okay. We again, as I'm reinforcing, we look at this as the grand Shanti time. The reason being is that the comfort, short-term pain, there is bound to be. Implementation, as Rohit said, also there is bound to be. But at the end of it, in terms of the cost savings that the members look at it, in terms of ease of doing business, which is the single most important thing. Point number 2 is in terms of preparedness. Yes, today we'll be required to fill in 34 forms per state. But if that is all computer generated, all you need to do is to do simple data entry. And it's going to be a process, I think, for about 18 months, there's going to be chaos. And after that, there is going to be the Shanti time. You take Malaysia. When they went in for GST, For 12 months, there was mayhem there. But today, there is Shanti. So at the chamber, we've started having seminars, which is every Saturday now. And we are getting fantastic response to the extent that literally people are being told that...
Right. So you're on a training mode and a workshop mode for...
And to even take issues which are there, which some of them, as Rohit said, has not been addressed, possibly. We take it up with...
Give any other illustration apart from the e-way bill that Rohit talked about?
Well, it's got
Prominent
to do with the cable industry, and particularly people in terms of railways. It's a big buyer of the cable industry from India. There, actually, the tax is going up substantially, so it's going to hurt the industry. And railways is an important infrastructure sector. So there, we've got Hasmukh Adia. He's a very willing listener. I mean, today that man, honestly, is going to places like Surat, Baroda, Vijayawada, etc. Because I invited him to come here. He said, Deepak, you got the best people. Anyway, so government is going all out. The chamber is going all out. Will there be chaos? 100%. Will implementation happen overnight? Definitely not. Are my people looking forward to it? Most certainly.
Right.
Because we see this as a major benefit.
Right. So, Rohit, is it would it be correct to say, therefore, that if you're not technology savvy or tech savvy or technology enabled, then you're going to have a very tough time adjusting to this new world, particularly if you're a SME, MSME, or obviously larger?
Not really, because SME, MSME and all, how many invoices typically they raise? It is they will anyway maintain their sales and purchase register. What GSTN expects you to do, they upload the sales and purchase registers. And today they would have appointed their consultant, their tax compliant people who will take care of their compliance. And somebody else today in this world and age, that somebody is maintaining their records in electronic form, whether they themselves are maintaining or they have been maintained by some outside people. But they have been maintaining outside people.
What would be your message for not done it so far, or not done it? Maybe let's say take shopkeepers, maybe shopkeepers with a fairly large revenue.
Let me just tell you back, Govind, that shopkeepers below 20 lakhs are out of GST. 20
that's what I meant.
20 to 50 are within composition scheme. They don't need to do anything but pay composition tax. Above 50 lakhs, reasonably even today they are maintaining their records on some electronic form.
Okay.
There will be hardly any people who would be there who are still maintaining on manual basis. Of course, they'll have to switch over and get into electronic form. The real challenge I see it at this stage is, let's take a tier 3, tier 4 towns and where ultimately it is electronic and internet driven, and there are not even internet connections which are working 24/7, and therefore that would be going to be a chaos, that you'll have to upload everything through a GST and you'll have to find then tier 2 people where they can help you to upload this, and therefore that is likely to be a chaos.
So you're saying connectivity could be one last mile.
Infrastructure, while we wanted to be an ideal position in terms of tax compliance, but is infrastructure supporting that today?
Okay, fair enough.
I have a disconnect with my co-panelist. Rohit, please forgive me. It's not in tier 3 alone. In tier 1, forget filling forms. There was no paying of any tax. There is a carpenter that I know in Kulaba. He does a turnover of 1 lakh a day, 3.5 crores a year. 6 people working. I'm not exaggerating. On 1st December, he didn't have a bank account last year. So he's come into the net now. So forget filling forms. He was not in the net. There's a Dhobi in New Bombay, in Airoli, 500 apartments, 1,200 per apartment per month is 72 lakhs a year. The guy would come in a chauffeur-driven car, never had any tax payment. So there are these. So therefore, liquidity with banks will increase substantially. With government, indirect taxation will increase substantially. Filling
But
of
how many such examples do you think there are?
There'll be tens of thousands, lakhs.
Okay.
I mean, outside Pune, there is a road on this thing. There are about 200 marble dealers. Average marble dealer there, I'm not exaggerating, does more than 30 crores turnover per year. They show
All in cash?
All in cash, 2.5 lakhs a month they declare. And there is one man who sits in Ganeshganj, prepares bills for all those people.
Right. I hope people are listening to.
I'm not joking.
Yeah,
Seriously. So I am very optimistic about the collection that will go up. Of course, there's going to be pain. It will give opportunity for new businesses to start to educate. Today, many people are not filling in electronically. It's by hand or whatever it is.
Yeah.
Firstly, not filling in. So is a filling in will start. So there is going to be a very major shift.
Right. Okay. And then most importantly, you're saying the migration of people who are not in the net to into the net, right?
Just to add what he's saying is absolutely right. Buoyancy and a transparency is what government is also really banking upon. Say today, as you say, income tax assessee, how many assessees in India out of 125 crore of population declares more than 3 lakhs rupees of income? It's hardly anything, some 25-30 lakhs people in the entire country. And that buoyancy, that transparency will really what government will be able to encash.
Right. So all of this now, I mean, if we were to look at the next, let's say, few weeks as we go into July, there's another meeting coming up on June 3rd where there are about 3 or 4 categories which have to be discussed: packaged foods, gold, foods, footwear and textiles. Any other areas of concern that we need to be looking at this point?
No, we've taken up in terms of hospitality, etc. These are issues some of our members have, and it's a genuine concern as he talks about, even in terms of restaurants, etc. It's a little unfair there, but it's not lopsided. Overall, I believe that cost of living is going to come down because of GDP, but not immediately. Immediately, it will increase. It will take another 18 months before the actually starts really percolating.
Right.
So in the short term, cost will go up, cost of living.
Right. And you're saying hospitality, you mean in that 2,500 to 5,000 and
correct. I'm talking of hotels, I'm talking of in terms of restaurants.
Okay.
Yeah, many industries have also made a representation post last announcement, including, as you started mention, movie tickets. Now, if that has been compared with the gambling and been taxed at 28%, definitely it's not logical that way. Similarly, a lot of other industries have made a representation that please reconsider the rates that you have put us into. And I think some of them would be re-looked at it and not all. While the last uncompleted agenda will be taken up, gold and textile and others, but these representations will have to be considered on 3rd June meeting if the 1st July is a real date.
Another area is services wise architecture, you take for instance. That's a booming thing in our country today, and there also the tax has gone up. I mean, in this new format that they have, which is incorrect, because complexes or townships are coming up, etc. So there is that disconnect, but overall there is going to be a substantial ease of doing business, and we are great supporters of this program.
Right.
Not because of the government, but because it is required.
Right. On that note, we've run out of time. Thank you both for joining me. Well, we need to go in for a break. Coming up on the other side, India has been having a hard time with rating agencies. We find out why and what can be done. Stay with us.
The sacred relics of Buddha were unearthed in Piprava in Uttar Pradesh. Buddhist monks from all over the world visit the National Museum to pay their respects. These charred bone fragments of Buddha are housed in the gold canopy gifted by the royal family of Thailand.
Welcome back to Policy Watch. India has had a difficult run with credit rating agencies for a while now. The most recent grouse appears to be the fact that many other countries with similar economic fundamentals have got strong ratings while India has not. India's chief economic advisor, Arvind Subramaniam, has said that in recent years, rating agencies have maintained India's BBB- rating, notwithstanding clear improvements in the country's economic fundamentals such as inflation, growth and current account performance. At the same time, China's rating has actually been upgraded to AA+, even though its fundamentals have deteriorated in the same time. He said to that question, so we are asking is, why is India's rating not improving? What is the impact of this? Are rating agencies seeing something that we are not? And what does India need to do if it has to find a solution to this problem? To discuss this, I'm joined by Madan Sabnavis, Chief Economist of CARE Ratings, and Brinda Jagidar, former Chief Economist at the State Bank of India. Thank you both for joining me. Brinda, let me begin with you. What constitutes a country rating? Just to get the basics out of the way.
Actually, it's the political and economic scenario which they take, and there are about 10-12 parameters: GDP growth, per capita growth, inflation, current account deficit, the political situation, default history, and a whole range of situations. So it gives an idea of the relative creditworthiness of the country.
Right.
What is the probability that the country will default?
Okay.
That's what.
Right. So, and would you know the weightages between, let's say, political and economic? And non?
I don't think it's fixed like that.
Okay.
It's a general assessment which the credit rating agencies make. I think Madan will be able to tell us something more about this.
Right. So let's bring Madan in. Madan, so first of all, why are we being singled out like this?
No, in fact, if you look at the developed countries and emerging markets, I think there's always been a kind of a dichotomy in the way in which the ratings really go. So it's always been a case of saying that India has been one of the best performing economies in terms of growth and other economic parameters. And I think one of the vindications that the economy is doing very well is about foreign investment. If you look at the amount of FDI and FPI which comes in, so we're really talking in terms of what investors feel about India, they're obviously gung-ho about India. But I think what the rating agencies look at are certain parameters like the debt parameters. I think these are some things which seem to be upsetting them all the time. And they never seem to be happy with the fact that even though we've had these FRBM rules and the government of India has been working very well within the confines of the FRBM, but somehow the debt to GDP ratio is something which is singled out as being some kind of a problem area for the rating agencies. I remember earlier they used to also talk in terms of FDI, but then we have opened up, we are probably getting the largest amount of FDI, and they were talking in terms of disinvestment, which has been slow. So I think these were the three major concerns which the rating agencies have been talking about, and I think we've definitely addressed one of them, which is FDI, and largely we have addressed the fiscal issues, but still they seem to be unhappy with the fact that our debt ratios are high, even though, as you have mentioned, our ratios are much better than those of some of the stronger developed economies.
That's the question. So when it comes to debt to GDP, I mean, where do we stand versus China, and are they, I mean, what could then be skewing the view on India and India's credit rating?
So in fact, if you're looking at it presently, I think if you compare India with, I'm not quite sure what the Chinese ratio, I think they may be lower than us, but if you look at US, UK, Japan, they definitely have much higher debt to GDP ratios. It will be more in the region of 100%, whereas ours is around 68%. But there is a bit of lack of conviction as far as the rating agencies are concerned when you're looking at Indian debt. And I think today, if you look at the Uday scheme, where we have seen a lot of transfer of Discom debt to the state government debt, the state government finances seem to be in a kind of a spot, something which we need to address. But I think the larger issue is that how much of importance we should be giving to it, given the fact that the government of India doesn't borrow from overseas markets. So the government is really not bothered about it. But it's only a case of saying that when Indian companies go to borrow from international markets, we need to pay a higher cost because the rating is lower. So I think that's one reason why we need to address this issue of fiscal, whether or not we like it.
Just going to come back to you on the borrowing part. Yeah.
You rightly said arbitrary, because China's credit rating has just been downgraded one notch, but then their outlook has been upgraded from negative to stable. So, and in India and China has been consistently performing poorer in the last few years, but then they have not touched the credit rating. While India's performance has been improving, India is one of the fastest growing economies in the world today. So now, just give me a moment. Now, for example, now Uruguay and Colombia, now their credit rating is better than India's at BBB. But then Uruguay's inflation is about 9.6% and Colombia at 7.5%. Look at India's under 5%. So that is one. And then Spain has the same credit rating as India, BBB minus. But Spain has a 20% unemployment rate. So it's really not fair. And in fact, I think that we deserve a credit rating much better than even France and UK. Because look at their GDP growth, doesn't compare anything with us at all. Look at their debt ratios. And their external debt is 200-300%, while ours is about 23-24%.
Right.
So clearly there is a dichotomy, and clearly there is something which the credit rating agencies are not addressing. I would say, they have not looked at India's default history. We haven't defaulted in the last at all. So we have a very clear history on that. Political stability. Tell me which country is as stable as India is today, in which democracy. And then we have import the forex reserves ratio import cover, which covers about 11 months of imports, which is very, very good. So, and then look at our potential for growth. So much is happening over here in terms of investment, in terms of ease of doing business. So going forward, I think the growth outlook is very bright. So this is not being looked at by the credit rating agencies. And I think if you look at the BRIC countries, for example, now India has the lowest credit rating. China, of course, and then the other Brazil, Russia, and China and South Africa at BBB, and India is the lowest. So, and if you look at their macro parameters and look at ours, I think it's very, very clear that there is an element of arbitrariness, and certainly I wouldn't rule out bias too.
Right. And let me understand the impact a little more, Madan. So one is, of course, country, and if we are not borrowing as a country, then maybe that's not too much of a concern. But we've seen some downgrades of corporate debt, and which in turn has affected their paper listed overseas. So do you see a link between the two?
No, absolutely. I think that's the only reason why we are too much worried. See, there's one thing to say there's a prestige issue where we like to say that even though we've moved up the ladder when it comes to the global competitiveness index or the doing business business index, ease of doing business for index of World Bank. But when it comes to the credit rating, I think really what happens is when Indian companies go and start borrowing from overseas markets, the risk perception goes up the moment you're BBB minus. So the kind of premium which you'll have to pay over LIBOR tends to increase. And I think that's one of the reasons why the government of India is concerned about the low rating. But I think one factor which I think whether or not we agree with the rating, I think something which we need to address today is of course the NPA issue. Because I think when the financial sector is weak, we need to make sure this number of 10 to 12% which we're talking of comes to a more reasonable level. Because I think the rating agencies are going to keep harping on this particular factor, saying, okay, maybe the economy is fastest growing, you have good inflation, you have a good current account deficit, good forex reserves, but what about the financial system?
Right, Madan, but are we being held to a higher standard than other countries? That's the question.
No, I think there is an inherent tendency to treat us more harsher than the other developed countries. But today in the current scenario, while we are all clamoring for a higher rating, I think we need to see as to what is something which is very weak in our system and which is the financial system. Because even in the past when we have seen...
What's the way forward then? Assuming, let's say, here are the data points, this is what people are looking at and not looking at. We may have some fresh data points coming in. Let's say we've got revised IIP index, we've got revised wholesale price index. Could there be a relook at because of all of this? I mean, not only because, let's say, we are upset with all of it, but
look at what the markets are telling you. We are able to borrow at much finer rates. Our companies, our best companies, are able to raise finances. Investors have confidence in India, so foreign investment is pouring in no matter what. And so I think all this is telling you that there is a lot going in the India story, which I think the credit rating agencies are definitely missing out. And it's not as if they have a very great history, a very great track record. So I think it's time they did revisit what parameters are and how the performance is.
Right. Then on the center versus state debt, now obviously state debt is also underwritten by the center, so to that extent it's protected. But obviously a lot of states are not in good fiscal condition. Is that something that we should be also wondering and focused about?
Yes, at some point certainly that is something for us to definitely worry about, but that is not an issue which is absolutely out of control or something which the credit rating agencies need to look at. I think because it's underwritten by the center, the debt is very much within limits.
Right. Madan, our Economic Affairs Secretary Shakti Danta said, he said that global rating agencies are far detached from ground realities. So what could that mean? I mean, what is the ground reality that we need to look at, even as economists or people observing the Indian economy versus, let's say, someone who's a rating agency specialist sitting outside?
No, in fact, I think when Mr. Shaktikanta Das spoke about the rating agencies being out of touch with reality, I think that's a fact, because if you look at the way in which whenever they give a kind of a rationale as to the reason as to why Indian rating has been maintained at the level of BBB-, it's always been given in terms of the government fiscals. But I think the fiscal numbers always seem to be something which is jarring them. And what we have seen in the last 3 years is that we have addressed most of them. The ratios are good, the quality of spending is good, we've managed to rationalize subsidies. And notwithstanding all these positives, we still see that the rating has remained unchanged. So definitely there is some reason for us to feel that we are not getting the right kind of rating from these rating agencies. And there seems to be some kind of an inherent bias where India always remains at a certain level. We never seem to be moving out of this, even though foreign investors don't love to invest in India, both in terms of direct investment or FPI. But I'll just go back to the point which I was making in terms of NPAs. Now that we have completed one part of the story, which is very much in order. We need to address this issue of NPAs and make sure that the financial system looks better, because this is an issue which is going to keep worrying the rating agencies whenever they're looking at India.
Madan, if you look at, you look at it historically, let's say over a 10-year period, we've had situations where maybe the NPA problem was not that bad, but the ratings were still low, isn't it?
No, at that particular point of time, our fiscals were not in order, because we were running fiscal deficit ratios of over 5%, 4.5%, 5.5%. So at the time when we have gotten our fiscal house in order, we suddenly see that, okay, there's this scheme which has come through where the state finances seem to be in a bit of disarray. And this is a time when we have suddenly realized that the NPA issue has come up. And mind you, the NPA issue is not incrementally more NPAs being created. It's more a case of recognizing them in a fairer manner, which has created this number of 10%. And whenever you have a weak financial system, it's always going to reflect not so well on the overall economy. That's a harsh fact which we should also realize and work towards improving it.
Madan, thanks for that. So, last word.
On the NPA issue, certainly China's NPA, we know that was in such a mess, but then that didn't get the credit agencies to downgrade China. So for 30 years, they maintained China's credit rating. So I think they're just they're moving the goalposts all the time, and they are really not looking at the reality.
So, and last word, what do we need to do? I mean, should we engage, disengage? I mean,
we
continue as before?
We continue to do what we are doing. We are putting our house in order, and we are making sure that all our parameters are within control. So we should continue to improve ourselves. We should continue to do what we are doing, and we should continue to showcase.
But make strong representation that we
Absolutely. We need to engage with them, certainly.
And as Shaktikanta Das said, they need to be better attached to ground realities rather than being detached. Okay,
Absolutely.
we're out of time. Thank you so much, Brinda and Madan. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.